Now let's take a look at the aging of a receivables method. Again, very similar to the percent of receivables method, but in this case here, we're looking at individual accounts based on how long they've been outstanding. Now, this, again, the theory of the longer that the account is outstanding, the less likely you're going to get paid. So let's take a look at this next slide. Now, with the aging of accounts receivable, we're going to list all our customer accounts and have aging categories, like 1 to 30 days outstanding, 31 to 60, and so on and so forth. And we're going to put the accounts based on the date of sale to say the date that we're running this aging. And we'll determine how many days are outstanding, and that customer balance is going to be in that respective aging category. Now, in this case here, since we're looking at the aging of AR, we've got all the accounts out here aged by dates. And so we've got a total down at the bottom, or down near the bottom, of the amounts in the aging dollar amounts. And then we have an estimate, and we've got that all totaled up. And we also have an estimated percentage uncollectible. Now, these are the percentages out here that we think are going to be uncollectible based on the aging categories. So normally, the more days outstanding, the higher these percentages go up. And you can see in the over 90-day category, pretty much we feel we're not going to get anything. So it's 90% or better. Then we'll multiply the dollar amount in the the aging category times the estimated uncollectible percentage. So we get an estimated dollar uncollectible amount. And then we'll add up the dollar amounts for the categories, and then that's our total balance, the 185. That's our target balance, and that's what we're looking should be in the allowance for doubtful accounts at the end of the period, or when we run this aging category. Okay? So again, what we're doing with the aging of receivables method is we're going to target the balance in the allowance for bad debt. Again, that 185 that we figured, that's going to be my balance in my AR, the allowance for bad debts. And then we'll determine the amount of bad debts by evaluating the allowance account. So in this case here, we've determined that, you know what, my allowance for bad debts should be 185 at the end of the year. In reality, we only have $55 in the unadjusted balance. So what we've got to do is figure out the difference. In this case, the difference is going to be $130. So at that point, we're going to make a debit to bad debt expense and credit the allowance for doubtful or allowance for bad debts by $130 also. So again, as you can see here with the balances that are out there, again, we're going to, since my allowance for doubtful accounts should have a credit balance of 185 at the end of the period, we need to adjust the allowance for bad debts by 130, and then we also need to make a debit to bad debt expense for 130 also. So with the allowance method here, again, you can see the direct write-off method versus the allowance method. The allowance method, again, we're making an adjustment out here to recognize bad debt expense, and that is okay. We can use estimates, and we're also matching our expense up against potential revenue that was generated, unlike the direct write-off method. So again, the allowance method here, and you can use the percent of sales, the percent of receivables, and the percent of aging of receivables as acceptable methods out there in order to estimate bad debt expense. Again, the direct write-off method does not allow you to do that. So again, you can see the comparison, with the income statement approach, and then the allowance method out there also. Truly, the aging of accounts receivable is probably your best approach because it uses more of a balance sheet approach, so you can estimate, and it gives you a better picture of what's going on in your business. And the other thing too is a more conservative estimate. So again, it matches the balance sheet approach here for the aging of AR meets a lot of accounting criteria. So in this one here, number 14, what we've got going on here is industrial equipment supply is a new business. During the first year of operations, credit sales were $44,000, and collections of credit sales were 37,000. One account was written off of 650, and management uses the aging of receivables method to account for bad debt expense and estimates $575 is uncollectible at the year end. Now, the ending balance of the allowance for bad debts, this really should be the 575 because this is what we're estimating as uncollectible as of year end. So number 14 here, this one's going to be D. So it's really what we're estimating. That should be the correct balance in the allowance for bad debts.